The largest options expiration event ever has come to the markets, and what happens here will have big impacts. Will it be to the downside or upside? In today's video, we take a look at both the trader and investor's mindset of what is about to occur next. Also, what did the Federal Reserve have to say about markets as we approach all-time highs for semiconductors? Volatility spikes once again, and of course, we come into the worst two-week period of the year. But actually what happens in July may surprise you. Could there be a new leader in town when it comes to lending and finance? Let's discuss it all today. Stocks, commodities, and cryptos. There's a lot to get into. We'll see you very soon. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss as usual. Big dark pool activities, macro, and of course, the key levels coming your way. But let's kick things off with the time of year that we're in, which is of course the back end of June. If you're not already aware, this tends to be the worst two-week period other than September back end of the year. And it is followed closely up by the best two-week period, which is the start of July. Oftentimes it looks like this, and according to the Stock Traders Almanac, since 1985, this is generally how markets have traded. Sometimes chop or even downward pressure on the markets, then rallying through July to get one of the better returns of the year. So could we be seeing a dip that Wall Street actually likes to purchase? Well, other than 2024, this is pretty normal. In fact, if you have a look here in July, you tend to see incredible gains. And of course, you often see in more recent years, maybe gains in June, but in previous years, declines, particularly 2022, which was a very nasty period. 8.91% lost in June, and a lot of that came in, of course, the back half. So why is all of this important? Well, it comes to the triple witching event. And if you're not aware of it, it's also known as quad witching. 21st of March, 20th of June, 19th of September and the 19th of December will be these big events of this year. And it basically means where all of the options expirations happen. And this one is the biggest ever. It seems like we say that almost every single time, but that's because it just keeps getting bigger and bigger and bigger. And this is basically leverage in the markets and heaps of people hedging. Now, I would say that because of what happened during March and April, we saw the biggest amounts of hedges come in. And that's why we have such a big options expiration. But it's not just what will happen here on the Friday of the session, it's also what will happen as people reposition on the Monday. And it could be that the Monday actually has more volatility in it than this Friday session indeed. And you can see here 6.5 trillion total contracts, triple witching right after the US holiday. So that's obviously a break in between. If you did celebrate that US holiday, hopefully you had a good time with your family and friends. And of course, dealers must reposition themselves. So this is quite a lot of expiration, and it will create some movements. You can see here on the latest net GEX charts here that the OPEX has quite a lot of expiration. And yeah, there's a lot of money that's going to be flowing around over the next two sessions in particular. Now, what does this mean for the period of June into July? Do we expect a sell-off? Well, if we drop a certain level on the S&P 500 we'll look at soon, then yeah, you'd have to expect the markets to flow down to a very particular zone. But remember what we've been saying all of 2025. We said this at the back end of 2024 on the channel. Remember to subscribe if you haven't already, if you're interested in this type of stuff. We suspected that this year would be chop. And the reason is because when you have excellent previous years, year one and year two, over 20% gains back to back, you tend to have a lackluster year three, and then usually a pretty good year four if the bull market continues. And there is a reason why this bull market may be continuing for now, and it has to do with technology. But let's have a look here at BlackRock's big calls, because of course BlackRock has a few things they're looking at, particularly 5 mega forces, which you may see if you pause the video down here. Demographic divergences, digital disruption thanks to AI, geopolitical fragmentation, futures of finance, which I think is a very important one. It says here, fast evolving financial architecture is changing how households and companies use cash, borrow, transact, and seek returns. Now remember, this year we're starting to see crypto AI and all sorts of new lending coming through, potentially through stable coins and other stuff. So this is a big move in finance, and it actually led to big sell-offs in MasterCard and Visa only over the last week. Transition to low carbon economy, that also is one of their 5 mega forces. So for BlackRock anyway, that's what they're kind of looking at. For us, we're basically focusing on more the flows and the structure. And if you actually have a look here, according to Citigroup, we're also seeing US economic data deteriorating in 2025. So the biggest issue here is going to be structure and flow. And what we'll be looking for is big key either distributions that look something like this towards the downside, or just continuous squeezes to the upside, which are based on usually pullbacks in time, which is something that we're seeing right now. Remember, the market will stay irrational for as long as possible to make as many people as possible look as stupid. So basically, markets can do whatever they feel like. They'll stay for a lot longer. And I always like the other comment that says, even if there is something out there, so there's a problem or a crack in the economy, it takes longer than anyone expects to finally show up as an issue. And I think for a lot of us out there, we've probably seen different things over time and we're thinking, how can this not be affecting the markets? And then eventually it does and you say, wow, I should have seen that coming. Well, it's not that you didn't, it just takes ages to show up. And in a special soon, we'll be talking about the commercial property market, which is starting to get even bigger in terms of a big problem. And will that end up causing an issue? Maybe. But do remember the commercial property market's been coming up as a problem now for the last 3 years. So it's in the 12 trillion plus range at this stage. US jobless claims creeping higher slowly. You can see here that this is a very normal thing to occur at this time of year. So again, if you see these kind of outlandish bad jobs numbers coming through, yes, it does tend to spike into the summer in the US. And then we see it kind of drop back down as people get hired up again. And I think this is what the Federal Reserve was really getting at. Now, in terms of the Federal Reserve board members and what they had to say, their main comments here from their projections for 2025 were lower economic growth overall, which probably is going to require some type of stimulus, higher unemployment, which also backs up with Goldman Sachs. Goldman Sachs believe that jobs numbers and growth in the economy is going to drop under 100,000 in terms of the non-farm payrolls. And we could be seeing higher inflation. Now, they're still concerned about that, but regardless, the dot plot still includes 2 cuts for this year. So we've got 2 more cuts this year. Obviously, I think Trump wants even more. And a lot of this is actually going to also come in 2026 when we see, the potential changeover of what's going on with the Fed. Tariff assumptions, median dot plot. You can pause the video here if you're interested in seeing kind of a quick summary of this June 2025 FOMC outcome. But at least to me, the big thing here is not so much what was said, it's whether we've seen a big movement in yields. And currently we just haven't seen that. It's still 2 cuts and the market didn't really have a huge effect on it. So while this is a great summary, it didn't really change too much at this stage. Now, what about gold? Well, we do know that gold and silver and Bitcoin have been the standouts of this year. I believe this is due to central bank purchasing, but also due to adoption of Bitcoin and geopolitical tensions. And of course, I kind of have said this for the last 2.5 years. We've talked about this together, that we think that this is probably not going to stop. And therefore, gold is now the preferred hedge by a lot of people in these markets. And that's why it's doing quite well. In terms of big losers, up until recently, we've obviously seen oil fall off a cliff. Treasuries have done nothing. These usually would do a lot more in these types of situations. And US dollar weakening and weakening and weakening. Although that is now a heavily shorted trade, the actual trend still is to the downside, and we've got that covered soon. What about the market? Can it climb higher even if it sells off now for a little bit? Well, the answer is generally yes. In fact, sector outperformance often tells us how markets are going to continue. According to this, the sector has outperformed, as in technology, 20 of 23 bull cycles, 87% since 1932. So if you had to have an argument of what the best sector to be in is generally technology, or I like to call it innovation. And yeah, if it's doing well, then the rest of the market usually claws along with it. So recently we've been tracking semiconductors in particular, because that's this huge part of the AI boom. And it's now at resistance and it's been kind of sitting around this zone. If that breaks towards the upside, then we have to assume that the pain trade begins back onto the bullish side, even if you don't believe that the markets are worth this much. Remember, it can stay irrational longer than you can remain solvent. Trump to make Iran strike decision within 2 weeks. Now, this was expected to potentially happen within 24 hours. And of course, it didn't, and now it's 2 weeks. So I guess it's kind of like, always going to be sitting over the top of the market. And again, it could be used as a reason for markets to sell off. So you've got to keep an eye on these headlines. It seems to change all the time. Obviously, the pizza orders and all sorts of things are going to be tracked heavily throughout the weekend. And this is always the risk nowadays of running stocks and trades into the weekend, is that something wild could occur, and that's going to create a big gap through the Monday session. What about big trades? Dark pools, there were a couple. Now, we did see on the Wednesday close, because of course Thursday market was closed, we actually got one of the biggest trades we've seen in a long time for the Russell 2000. Was it a buy? Was it a sell? I guess we don't know yet. We'll let the market actually decide on that. But as you can see, often it does come where we build an accumulation for a while, and then that led to bullishness. Could this be another accumulation? Is it a sell? We don't know, but we will be watching closely. We also got another big one for Google, and these have tended to end up in, again, consolidatory kind of periods. This one was a sell. This one here, is it a buy? Is it a sell? We don't know yet, but we will be looking for the reaction. So do remember, these large trades help us to ascertain that this is an important area. And then now when we see the flow start to move, then we can say, we see what they're doing. First 100 days and beyond, we're now at 150 plus. So we're at that point that we would expect to be recovering back to the all-time highs. Funnily enough, that's exactly where we find ourselves in markets. We're about to now enter into the period of what happens next. Are we going to have that sell-off in June, rally into July, and then questionable August, September? Well, that is the question mark, and we're looking very closely at the signs here. Of course, all of us are doing the work to find out what is possibly coming up next, and of course, we'll bring the data, we'll bring the flows, and more importantly, we'll bring those dark pool transactions. So what else has been happening? Well, we've got a pretty much vertical.
Merck & Company has raised its quarterly dividend from 77 cents to 81 cents per share. This marks 14 consecutive years of increases. The company reported first quarter 2025 revenues of $15.53 billion and earnings per share of $2.22, exceeding estimates. The current dividend yield is 4%. Walmart Incorporated is considering the development of its own stablecoins for digital transactions, enhancing its financial innovation. The company also boasts 52 years of consecutive dividend growth, offering a quarterly dividend of $0.235 per share with a yield of 0.98%. Costco Wholesale Corporation has outperformed Dollar General. While Dollar General declined by nearly 12%, Costco's shares rose by over 13% over the past year. This indicates strong market performance compared to competitors.